Rates may be impacted by the additions on your car. An insurance provider will need to know the make and model of your car, as well as if it has high-end accessories, which may result in higher insurance costs. They may also consider the car's safety rating, year of manufacture, and probability of theft. Top tip. There are several elements that influence car insurance prices, so if you're thinking about buying a new car, check on the specifics of the vehicle before committing. 2. Where you live might cost you. Depending on where you live, insurance may cost more or less. Because high-density locations have a higher accident rate, the rate reflects that danger. Another factor that might boost prices is if your community has a high rate of car theft. However, insurance costs are higher than the national average in states like Michigan, where there are more cases of insurance fraud and uninsured drivers. 3. Teen drivers may increase your rate. Adolescent drivers have the greatest collision rate of any age group, so adding a new driver to your policy may have an impact on your pocketbook. Check with another provider to see if the cost of a policy with a teen is lower, or ask your present provider if they provide a discounted rate for multiple drivers. Several insurance companies provide a discount to teenagers who get high grades in school. Loans are a factor. Insurance costs are a factor in determining whether you purchase a car outright or acquire a bank loan for it. A bank may require you to carry additional collision coverage or pay more premiums to make sure their loan is covered in the case of an accident or other damage to your car. When you sign a loan for your car, check with your bank to see what sort of insurance coverage they may require you to have. 5. You may be involved in an accident. The Comprehensive Loss Underwriting Exchange, CLUE, and the Verisk Automated Property Loss Underwriting System are two databases that insurance firms have access to. These databases allow them to know if you've made a claim or been in an accident, which they may factor into your insurance costs. These investigations can reveal up to 7 years of claims for a company, so switching providers may not help you avoid a past problem. Pro tip. You may obtain a free copy of your Consumer Disclosure Report from LexisNexis and a Verisk A+ Loss History Report to see what information insurance providers have access to and whether any revisions are required. 6. Loyalty may not always equate to financial savings. You may believe that remaining with the same insurance provider for numerous years qualifies you for a loyal driver discount, but you should conduct some comparison shopping. While loyalty is crucial, it also shows providers that you're at ease where you are, which they may utilize to increase your rate. If you see an increase, try renegotiating or getting estimates from other providers to see if moving on may save you money. 7. Monitoring might not save you money. Several insurance companies enable you to install monitoring devices in order to obtain safe driver discounts. These gadgets, or applications, may measure how far you drive, how hard you brake, or when you're on the road. Information like this are converted into data points that the insurance provider can analyze. But, in some states, insurance providers may be allowed to utilize this information to increase your premiums based on any bad driving patterns they detect. When deciding to use a monitoring device, make sure you understand the specifics of the state in which you live. They do not advertise a discount. If you want to reduce your insurance costs, it may be beneficial to be proactive about any potential savings you might acquire. Contact your insurance carrier to see if they have any unadvertised incentives that you are missing out on, such as good student or loyal customer discounts. Inquire about possible rate reductions for combining house and car insurance. 9. Insurance companies are aware of your credit score. Insurance firms may argue that a driver's credit score reflects their capacity to pay premiums or even their riskiness to insure. Someone with a low credit score may be judged a higher risk by an insurance provider, and this may factor into rate calculations. Top tip. If you're concerned about how it can affect your insurance prices, learn about what defines a good credit score and how you might potentially improve it. 10. Reduced premiums may cost you. Reduced car insurance costs may seem fantastic if it means paying less than your existing plan, but make sure you compare more than just your monthly premiums. Reduced premiums may indicate that you have a plan with a large deductible, which means you will have to pay more out of pocket for any repairs or damage before your insurance kicks in.